Hi, and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's see the analysis.
$3.35. That was the closing price of Abits Group Inc., ticker ABTS, as of the market close for the week ending February 19th, 2026. $3.35.
A very heavy number.
It really is. Now just hold that number in your head for a second and compare it to the 52-week high we saw just a few months ago in October 2025. Back then, the stock touched $10.86. That is a roughly 70% haircut in under 5 months. But honestly, the price action isn't even the most startling metric here. It is the volume.
Right. The volume is the tell.
Exactly. We are looking at a stock where the average daily volume typically drifts between 4,300 and roughly 10,000 shares. It's sleepy, it's a microcap, but recently on these high volatility days, we have seen spikes as high as 11.27 million shares. I mean, that is not retail investors clicking buttons on their phones. That is massive institutional churn.
It is a staggering amount of churn. And frankly, those numbers paint a portrait of a miner fighting for its very life in the Tennessee Valley. That drop you just mentioned, it's not just a standard market correction. We're down significantly from the year-end stabilization of $5.15 in 2025. So here we are. It is Saturday, February 21st, 2026, and we are looking at a company that has lost a massive chunk of its capitalization in a matter of months. The central tension here is pretty unavoidable. Is this $3.35 price tag a massive discount on a pure-play Bitcoin miner that is about to scale? Or is it the final gasp of a company with a frighteningly thin balance sheet?
I see why the chart looks ugly to you. I really do. It has been a brutal winter for the sector overall, and small caps always get hit the hardest. But I look at that exact same data, and I see a company that has successfully pivoted from a legacy Chinese media business which, let's be honest, was a dead end, to a highly focused U.S. mining operation. They have improved efficiency, they have cut costs, and they are sitting on infrastructure that is effectively a coiled spring. If Bitcoin rallies, even just a little bit, I see a potential 5x return from these levels.
Well, I come at it from a completely different angle. I look at that same pivot and I see a classic value trap. I see a company burdened by high-interest debt that it can barely service, a missed strategic opportunity to pivot toward AI like its smarter competitors, and a liquidity profile that is frankly terrifying. We are talking about a company that reported having less than $100,000 in cash late last year. That isn't a coiled spring. That is a company running on fumes.
I think you're focusing way too much on the bank account snapshot and not nearly enough on the engineering trajectory. The market is ignoring the fundamental transformation that has happened on the ground here. I want to talk about Duff, Tennessee. This is their cell phone facility, and it represents a success story of micro-efficiency that just doesn't get enough credit. In this industry, everyone obsesses over exahash. You know how much total computing power you have. It's the headline number everyone wants. But nobody talks enough about the boring stuff, the OPEX, specifically the cost of the water cooling.
Because usually, water bills don't bankrupt companies, electricity bills do.
Right, but in high-density mining, water is electricity in a sense. It's the efficiency multiplier. If your rigs run too hot, they draw more power for less work. Throughout 2025, Abits invested heavily in infrastructure at Duff. They didn't just plug in machines. They actually drilled 2 industrial water wells on site. Now that sounds mundane, but think about the physics of it. High-performance mining rigs generate immense heat. If you can't clear that heat, the chips throttle down and you lose revenue. By drilling their own wells, they drove an 18% reduction in water utility expenses. That is pure margin that goes straight to the bottom line because they aren't paying municipal rates for thousands of gallons of coolant.
I get the physics, but does it actually move the needle on production, or is it just a nice science project to talk about on an earnings call?
It absolutely does move the needle. In the third quarter of 2025, that specific facility saw a 12% improvement in mining efficiency. They aren't just burning power anymore, they are optimizing it. And the revenue story backs this up perfectly. We went from $1.7 million in fiscal year 2023 up to $6.7 million in 2024. And as of the third quarter of 2025, the trailing 12-month revenue was sitting at $7.04 million. That is a growth trajectory you just can't ignore.
The revenue growth is there, I grant you that. But there is an old saying on Wall Street, revenue is vanity, profit is sanity, but cash is reality.
And they are maximizing the reality they can control, which is efficiency and output. I mean, they produced over 13 Bitcoin in Q3 2025 alone at Duff. They are positioning themselves to be the prime beneficiary when the Bitcoin price moves.
I'm sorry, but I just don't buy that the operational improvements are enough to save them. You can drill all the water wells you want in Tennessee, but if you run out of cash, the lights go out. You glossed over the cash position earlier, but I need to put the specific number on the table because it is shocking. At the end of 2024, Abits had $1.12 million in cash. By September 2025, that number had evaporated to $94,132. $94,000. For a public company listed on the NASDAQ, that is less than the cost of a single high-end luxury SUV.
They were reinvesting in expansion. You have to spend money to build capacity. That cash went into the ground and into the racks.
They were bleeding. And let's not forget how they managed to stay listed on the NASDAQ in the first place.
In March 2025, just a year ago, they had to execute a 1-for-15 reverse stock split just to get the bid price over $1.
That was a standard compliance move, and it worked. They are still listed.
It's a signal of extreme weakness. Healthy companies don't reverse split to survive. They split to make shares more affordable because they've grown too much. And then, in February 2025, shareholders approved unlimited authorized shares. When I see a company with $94,000 in the bank asking for permission to print unlimited shares, I don't see a growth story. I see a setup for massive shareholder dilution. With a negative PE ratio and that kind of liquidity, they are one bad month away from insolvency.
That is a very harsh assessment of what is honestly a standard capital-intensive growth phase for a microcap. But let's get into the strategy, because I think that is where the real disagreement lies today. You mentioned earlier that they missed the pivot to AI. This is the narrative everyone loves right now. If you aren't doing high-performance computing, or HPC, you're dying. But I completely disagree with the premise.
How can you disagree with it? Look at the competitors. Look at CleanSpark. Look at Riot Platforms. They are aggressively pivoting to high-performance computing and AI data centers. Why? Because it offers stable, high-margin revenue that isn't totally dependent on the volatile price of a digital coin. Abits is sitting there in Tennessee purely mining Bitcoin. They are stuck. And they are stuck because they can't afford the pivot. Do you know what it costs to build an AI-ready facility right now? It costs between $8 million and $11 million per megawatt. Abits has a market cap of around $6 million. They literally cannot afford to even enter the room.
That is true, they can't afford that pivot. But I would frame it differently. I don't view their lack of AI exposure as a weakness at all. I view it as a specific investment thesis. Think about the investor. If an investor wants exposure to AI, they buy NVIDIA, or they buy a tech ETF. If they want a diluted miner that is trying to be half a data center, maybe they buy Riot. But Abits offers concentrated exposure. It is a pure play.
It's unhedged exposure.
Exactly. It is a high beta proxy.
Maybe explain high beta for the listeners who might not be day trading.
Sure. High beta just means the stock moves more than the underlying asset. If Bitcoin goes up 10%, a high beta miner might go up 20 or 30% because their margins expand exponentially. If Bitcoin runs to $250,000, you want a company that is 100% leveraged to that price action, not one that is worrying about service-level agreements for some cloud compute client. AI requires 99.9% uptime. You need redundancy, you need fiber, you need to be perfect. Bitcoin mining is interruptible. You can turn a miner off when power prices spike. It is a completely different business model. Abits knows this. They doubled their capacity to 22 megawatts with the Memphis expansion. They are aiming for 1 exahash per second. They know what they are, and they are staying in their lane.
Staying in your lane is fine, unless the lane is a dead end. And that brings me to the engine driving this car, debt. We have to talk about the loan they took out in April 2025. $3 million.
Which was necessary to fund the Memphis equipment. Without that capital, there's no growth at all.
Let's look at the terms, though. This isn't a cheap line of credit from a Tier 1 bank like JP Morgan. This is 12% simple interest. They are on the hook for $30,000 a month in interest payments alone, plus the principal repayment. For a company that generates around $1.6 million in revenue a quarter, revenue that fluctuates wildly with the Bitcoin price, by the way, that fixed cost is an anvil around their neck.
It is a cost of doing business, and you are completely ignoring what that debt bought them. It bought them the Memphis joint venture. Abits keeps 66.5% of the profit from that site. In the third quarter of 2025, that segment contributed over $429,000 in profit. Do the math. $429,000 in profit covers the $30,000 monthly interest payment multiple times over.
Assuming the Bitcoin price holds. Assuming the network difficulty doesn't spike.
And assuming they manage the capital correctly. Which is exactly why I am bullish on the new leadership. They brought in Kai Zhang as CFO on January 1st of this year. You don't bring in a new CFO in the middle of a crisis unless you are preparing to discipline the capital structure. I'm not convinced by the debt-death spiral argument because the assets are actually performing. The debt is manageable if Bitcoin remains stable or grows.
That is a massive if. Bitcoin is the most volatile asset class in history. Betting your solvency on it staying stable is reckless. But let's pivot to the valuation. You threw out a 5x number in your opening. That implies a stock price over $15. How do you justify a $30 million market cap for a company with negative earnings and barely any cash?
It is a path based on asset value and potential. Right now, the stock is trading at a price-to-book ratio of 0.61.
Meaning
the market is valuing the company at roughly 60% of the actual value of its hard assets. Its rigs, its infrastructure, its Bitcoin treasury. You are buying $1 of assets for 60 cents. That is the very definition of deep value. If Bitcoin trends toward $250,000 over the next few years, the value of their treasury, which was at $2.49 million late last year, balloons. Furthermore, look at the map. They have a 22-megawatt footprint in the Tennessee Valley. They have the water rights, they have the cooling infrastructure we talked about. If a larger miner wants to consolidate in that region, Abits is a prime takeover target. A buyout at fair value would instantly realize that 5x return.
That is a compelling argument on paper, but have you considered the dilution required to get there? You talk about a $30 million market cap. I am telling you that existing shareholders might never see that benefit. If they have to use that unlimited share authorization to pay off the $3 million loan, the share count explodes. Think of it like a pizza. The market cap is the size of the whole pizza. You might make the pizza 5 times bigger, but if you cut it into 1 million tiny slices to pay your debts, my individual slice, my share, doesn't get any bigger. The share price could stay flat or even drop while the market cap goes up. And there is an elephant in the room we haven't touched yet, the halving.
I knew you would bring this up.
I have to. We have halving events coming in 2028 and 2032. For those listening who are new to this, the halving is when the amount of Bitcoin a miner gets for solving a block is cut in half. It is hard-coded into the protocol. The block reward gets cut to 1.5625 Bitcoin.
That is 2 years away. In crypto time, that is a decade.
In mining economics, that is tomorrow. These machines have a multi-year lifespan. If Abits is struggling to break even now with the current block reward, how do they survive when the revenue is cut in half mechanically? They just don't have the balance sheet to weather that storm.
They survive by doing exactly what they did at Duff, increasing efficiency. The miners who survive the halving are the ones with the lowest cost of production. By cutting water costs, by using efficient liquid cooling, they drive down their cost per coin. And frankly, they are relying on the appreciation of the asset. History shows that after every halving, the supply shock drives the price of Bitcoin up.
Hope is not a strategy.
It's not hope. It's leverage. It is understanding the cycle.
Let's wrap this up because I think we have found the fundamental disconnect here. I look at Abits Group and I see a satellite position at absolute best, but much more likely a value trap. The operational improvements at Duff are impressive. I will give you that. The water wells, the efficiency gains,
It is good engineering. But finance is a ruthless game. The math problem of $94,000 in cash versus $3 million in high-interest debt is incredibly hard to solve without hurting shareholders. The only lever they have left to pull is dilution. They will print shares to pay bills, and the retail investor will pay the price.
And I summarize it this way. The market has oversold the fear here. The company has stabilized revenue. They have narrowed their net losses from $21.5 million in 2022 to under $1 million in 2024. That is a massive turnaround. They hold a growing treasury of Bitcoin, nearly $2.5 million worth as of late last year. They are trading below the value of their own machines. If you believe in Bitcoin, you buy the miners that are priced for bankruptcy but aren't actually going bankrupt. That is where the alpha is.
We can agree on one thing, I think. Abits Group represents the extreme end of the risk curve.
Absolutely. This is a micro-cap levered to Bitcoin's price, fighting for survival in the gap between the last halving and the next.
For Abits, the only thing that matters is the price of Bitcoin and the cost of the next kilowatt hour.
If you like this video and want to watch more content like this, don't forget to subscribe. Thanks for watching. See you.